Hey, it's Jairus Days. Welcome back to the week. This is episode 686 of your Daily Detroit, released on Monday, February 1st, 2021. There are a ton of ways to look at what happened last week with GameStop, Reddit, hedge funds, and Wall Street, but I tend to look at the more practical side of things. What's changed, what didn't, and what are some things to think about for you going forward? See, I saw a lot of hype last week, but the more I dug into this, the more I realized what we needed to talk about is what to do next. To help unpack that, friend of the pod, Matthew X. Rowling, is back. He's known as Professor X on YouTube, teaching personal finance, and in his day job, he's the head of Wayne State's Office of Business Innovation. So I'm going to grab some chicken tenders and get to it after I thank our members on Patreon. We believe in a value for value model where those who can support the show to keep it available to everyone in our local community. Local information is under threat in a number of ways, but we all can keep it going with your support. You can join the cool people like Bob, Lissa, Jonathan, Halima, Amber, Nikki, and Emily at patreon.com/dailydetroit. And if you have feedback for the show, leave us a voicemail at 313-789-3211. That's 313-789-3211. And well, let's just get started. Daily Detroit listeners know you, and welcome back.
Good to be back, Jared. Thanks for having me.
So I couldn't think of anybody better to talk to around what is actually happening out there with GameStop, the market, the Robinhood, all those terms that everyone's hearing right now, but then also talk about practically what people should do and what people need to think about with their own money and the systems. And of course, before we do this, this is not individual investor advice. This is kind of like a more of a toolkit or a guide as opposed to your individual situation, right?
Yeah, keep me out of hot water. I don't anybody coming after me if they lose some money based on anything I said. So just for the caveat.
Yes, got to throw in the caveats with all of this stuff I've learned. But let's start off with what actually happened here, because there are so many differing narratives. And as I have dived into it, looking at the people who are actually willing to talk and willing to kind of unroll everything. There was actually a great video that I saw from the folks over at Benzinga, which are actually partially based here in Detroit, kind of unwrapping like what actually happened behind the scenes. And it's a lot different than what people on social media claim it to be.
Absolutely. And I think it helps to take a big step back so we can really set a good context. The investment community in Wall Street, kind of saw GameStop as a 2020 equivalent to Blockbuster. They said, here's a retailer, a brick and mortar retailer that sells video games to human beings that walk into a store. And most human beings are buying or streaming or downloading video games digitally. So we don't think this business is going to last much longer. And what Wall Street oftentimes does in these situations through hedge funds is that they will start to short the stock and anticipate that the company will go bankrupt and the shares will become worthless. This happened with Hertz, rental car, and obviously a number of other stocks, AMC, Bed Bath & Beyond, et cetera. And so a lot of the hedge funds and the Wall Street vultures, for lack of a better word, started to circle these companies. My kind of editorial on this, Jer, is that sometimes if the vultures start circling, they have the ability to kind of create a run on a company's stock, and they oftentimes can, in my opinion, prematurely put a company out of business, right? If you're an employee or a customer or a supplier of a business and the share price is tanking, it doesn't exactly fill you with enthusiasm. So that practice of shorting vulnerable companies is kind of the backdrop. What happened the last several months, in my opinion, it's a timeless battle on a new stage. People have been trying to manipulate the market since we started having markets. This is just a brand new forum or format for doing that. There was the Reddit community of Wall Street Bets, where sophisticated people who were members of this community recognized that these companies, specifically GameStop, had been massively shorted by Wall Street and that there was an opportunity to strategically and collectively take them down.
And that take them down is interesting because that take them down applies to both sides of this whole situation, right? You got Wall Street looking to make a profit by taking down GameStop. And then on the other side, you've got basically day traders, app traders on a variety of platforms self-organizing and then saying, we're going to take down Wall Street.
Jared, I did the back of the envelope math. And if you were, Melvin Capital or a hedge fund, if you put a short in on GameStop at $4, people have heard this, probably many times, but so you got to put up 50% of the share's value as a margin, right? And so if you shorted GameStop at $4 a share and you put $100,000 into that bet, when the share price hit 300, you were out 7.5 million.
Wow.
Yeah.
Wow. That's stunning.
And $100,000 is an extremely small hedge fund bet. Their bets are usually 7 or 8 figure bets. A $10 million short on GameStop would have had a margin call of $750 million.
Well, and there were a lot of people who have shared their stories about what their personal accounts have made on the other side of this deal, but I can't help but think that there are differing structures happening than what's in the popular narrative. And I mentioned that video from Benzinga in the opening. I will be sure to link to that. But one of the things about this is that the whole market kind of showed how the gears can gum up really quickly when stocks, as you're talking about, there's that huge short and then there's that huge rally where, all these stocks, people realize they're not really trading with another person. They're trading with the street. When they sell a stock like in an app, there's usually not someone else on the other side sitting there taking it.
These are really sophisticated exchanges, but they're still, like anything else, they're a system of connecting buyers and sellers, in this case with securities. Even the best systems can still succumb to a bottleneck. And, the volatility that GameStop experienced and the interest and the volume, in a lot of ways, the system seized up at a number of different points the last week, which only made it harder for both sides to try and do the things that they were trying to do. It just kind of exacerbated the problem.
Yeah, because you've got those systemic issues. And then there are issues with apps like Robinhood in general, right? Like, I think a lot of people got into the marketing of, go from the rich to the poor. But if you had been following the news around them, they had to settle with the SEC for a fine for not being clear and disclosing how they make money. And I feel like there's a lot of folks who jumped in and didn't really have the background, shall we say.
People that know me or follow me. I've been extremely anti-Robinhood the moment I understood how they made money, because I think that they're, kind of another example, unfortunately, of if the product is free, you're the product. Predatory nature of Silicon Valley. Robinhood markets itself with every single person knows what Robinhood does, right? He steals from the rich and gives to the poor, right? How Robinhood makes their money is they offer a free trading platform to individual investors. But if I use a traditional brokerage account and I sell a stock, the broker automatically sends that trade to the electronic exchange and it gets filled as soon as there's a willing buyer, right? Or seller. And with Robinhood, they would use an intermediary that would batch the orders. And oftentimes they might wait for the stock to go up a penny or two. And then they would pocket the difference and pass back some of that revenue to Robinhood. My understanding is that's about 70% of Robinhood's revenue. That means that if you're the investor, you're not getting the best execution on your trades. Perversely, Robinhood was stealing from the poor and giving to the rich. And if you weren't sure about that, all you had to do was pay attention to what happened on Thursday.
Yeah, because this is not a situation where I think anyone has any sympathy for the hedge funds whatsoever. Overall, what it seems to me as we're unpacking this a few days later is a fundamentally broken system on many sides.
Absolutely. There's, options and derivatives, they magnify returns, but there are legitimate purposes for some of these financial tools. And the classic example is the Midwest farmer, right? That, 50 years, 100 years ago, or whatever the case might be, even today, I imagine, right? They've got a crop. They spend all year investing capital in growing their crop. And meanwhile, all year long, there's a market for that crop that's bouncing around as markets do, right? And so that farmer would go to a broker or go to the, Chicago Board of Trade, and they'd say, hey, you know what? In 6 months, I'm going to have this crop of wheat, and I don't want to have to worry about what wheat prices are going to be in 6 months, right? And so a speculator would enter into a futures agreement with that farmer, and the farmer locked in the price, so they were happy, and the speculator got to make a lot of money or lose a lot of money based on where prices ultimately landed. There's a lot of really practical ways that some of these tools can help people and organizations hedge risk. But sometimes these tools, don't really have strong utility applications outside of simply betting or wagering. I don't really have a good bead on if there will be any legal or regulatory fallout. Wall Street has a pretty good history of, skirting these issues and ultimately just continuing down the path. So I don't know. The amazing thing for me was, the other day we saw AOC and Ted Cruz agree via tweet that this was problematic.
Ever so brief agreement.
Ever so briefly. So maybe that's a signal that there will be some progress here.
Well, you talked about that lack of regulatory oversight or basically consequences for people. And that's something reading a number of sources. It's been going on for many years. And part of the moves that were made, it's not just about making money for a lot of individual investors. There were a number of people in this GameStop trade and currently in the market right now that, yeah, maybe making money is part of it, but also, punching a hedge fund guy in the face is worth it, even if they lose money, because there's so much anger in the system. I can't tell you how many of my friends' parents lost their houses. I can't tell you how much economic destruction. I mean, you and I both live in the city, how bad 2008 hurt Detroit. So there's a lot of pent up real anger. All this happened. Nobody bared any responsibility. And then now you have those same CEOs in some cases parading around. I'll just use Detroit as an example, parading around the city going, look at all the things we're investing in. And there's a lot of people out there who goes, hey, you're the guy who broke this.
I can't argue with a single thing you said. And trust me, I love the David versus Goliath story as much as the next person. I'm a big fan of the underdog. And certainly, a lot of very, very wealthy people got taken by in the woodshed with GameStop. My problem with that narrative is that a lot of the people that amassed significant holdings in GameStop early on, and I think a lot of the people that were the provocateurs stirring the pot on the Reddit page, for all we know, they were people that worked on hedge funds as well. And we do know that a lot of those people that did invest early were people who were incredibly affluent to begin with. So my fear is that, with the greed and hype and mania that surrounded this, that a lot of people will jump into the pool not understanding that they're swimming with sharks.
Looking at social media even, the number of people who all of a sudden, it seems like, and I don't mean to be glib about this, but I feel like in the last year, we've all become virus experts, constitutional law experts, and now financial experts, in part because we're all sitting here without as many things to do, and then also really frustrated, like honestly frustrated about what's happening in the world. But what I worry about that is that I also see opportunities where people could really financially lose something.
I have a master's degree in finance and accounting. I'm a CPA. I teach personal finance. I don't speculate. And the times I do, every blue moon that I do, then I get slapped upside the head, and it reminds me that you just have to kind of stay the course. Jared, there's this army of the PhDs and MBAs of the world. They flock to these cities, and they have the best resources and the best information, and it's their job to win every day in the market. You're not going to beat these folks in your spare time. But the good news, and I think where the stock market can be a tremendous source of helping people build wealth, is over time. I'm not going to time the market. You're not going to time the market. But if you spend a lot of time in the market and you have a long-term horizon, Wall Street's not worried about, 2040 when you want to retire, or whatever the case might be. So if you just patiently, diligently build a diversified portfolio. I know this is very boring. As Warren Buffett says, no one wants to get rich slow. You just take your time, be mindful of your fees, be mindful of diversification. Don't look at the ebbs and flows over the course of a day or a week or a month. It can be a tremendous source of wealth for people.
Well, I think a lot of the attractiveness, though, unfortunately, is looking at that minute by minute, sharing the ups and downs, and I guess that's the thing with these apps. It's the gamification of investing. And I want to get into this. You talk about these practical tips. There's a difference between if you want to basically play at the casino and take $100 or whatever you're going to take and say, this is my fun money, versus, okay, I want to actually build wealth and actually do something with this.
That actually gets to the thing about Robinhood that, in my opinion, is the most insidious. And, if you look at TD Ameritrade and Schwab, if you look at the user interface, the user experience, it's a little stodgy, a little boring, and that's that, right? But Robinhood made it fun. If anyone that has the app or has used it, there's emojis and confetti, and it looks and feels like a slot because they make their money the more you trade. I just got done telling you, the more you trade, the more churn you have in your portfolio, odds are you're not going to beat the market. They were gamifying the element that made them the most money, but sadly statistically expose their users to the most loss.
I have played with it a bit. I've played with a number of these just for the research for this. It seems like a social media app for investing, which I feel like the two things are very different and the same kinds of rot that can happen. I mean, there's good things that happen on social media too, of course, but the same kinds of dangers and rot, they're there too.
The reason the stock market exists because it is an incredibly large, deep, efficient source of capital for companies. But if you buy General Motors, right, that depth and that efficiency means that every day, the shares are trading and they go up and they go down. But if you think about it fundamentally, General Motors or Apple or Google, from a day-to-day basis, the businesses aren't changing that much. If you're kind of gambling on the daily up and down, you're really just betting on whether or not a bunch of people around the world are going to buy more or buy less of a given stock. It's only over the course of time that these companies can really build out great products and great services and generate cash flows and start to grow their business in a way that creates what in the industry you'd call fundamentals that drive the stock price up. Does that make sense? I hope I did.
Yeah, and to illustrate a little bit, if we think about the companies that people, I don't know if they necessarily look up to, but if you look at them and go, wow, they're actually having staying power and impact. You look at, what Warren Buffett does and his holdings, but then you also look at Jeff Bezos and Amazon. One of the big advantages that Amazon had that I don't think it's talked about enough is that they were playing a long game where everyone else was playing quarterly. Despite all of their mistakes and all the things that people can talk about as far as criticism, that fundamental decision, I believe, underpins Amazon's success to this day, where they literally had notices in their stocks saying, this is not for quarterly trading. Like, this, do not expect X or Y. And that was very different and very controversial, but it has proven out that long ball really, really wins.
Oh, absolutely. And Warren Buffett is one of the wealthiest human beings on the face of the planet, and he's an incredibly patient investor. He buys and holds, and he buys companies he believes in. My advice to everyone out there is, if you're going to invest in a company, you want to do your homework and you want to believe in the company and the industry and the management team and the fundamentals. But if you buy a stock and you really believe in it, you shouldn't really care if it goes up or down from day to day because you're buying it for the long haul. And I think that mindset is. And look, I'm not oblivious to behavioral psychology. It's really fun to there are a few things more rewarding as a human being than a random payout. So I get it. Is your goal to have fun and to seek the highs and the lows, or is your goal to build wealth? If your goal is to build wealth, you need to uninstall Robinhood and quit day trading.
Well, then let's talk about what to do next, because you've talked a little bit in the past with me about kind of individual steps you can take, but there are a set of steps that anyone can take that if you're already invested in something like, using a Robinhood or something like that, and you hear this and you go, okay, Professor, I hear you. What next?
Okay, so if your goal is wealth, you want to build wealth. We live in the United States, for crying out loud. It's building wealth is, I think, somewhere, it's somewhere in the genetic code, right? Rule number one is you've really got to get rid of your toxic debt. I'd be remiss if I didn't take a step back and say, you shouldn't be playing the market. If you have a credit card that is charging you 20%, and the stock market on any given year usually returns about 7 or 9, your money would be better spent paying off your credit card debt. So that's kind of rule number one. Rule number two is build a little safety net, a little, 3 to 6 months of emergency cash that is not invested in anything with any type of volatility. That's just in case of emergency, break glass.
Like a savings account or something like that. Where would you put that?
Ideally, something that's FDIC insured, credit union, bank, something like that. You're not going to generate a lot of return. But from my point of view, Jer, if there's so many life events that creep up, right? You've got a bad boss, you've got a sick relative, you lose your job, you have to move, you have a child or a dependent. You don't want to add insult to injury by living paycheck to paycheck. And you can live paycheck to paycheck making 100 grand or 20 grand, right? But if you've got 6 months of cash sitting somewhere safe, you can just deal with the emotional impact of those events and not have to worry about the financial impacts. And I know 3 to 6 months sounds like a lot, but I think the last 12 months has shown us that there's nothing wrong with that. You got to kind of have that in the bank. Paying off your credit card debt or your revolving debt, giving yourself a little bit of cushion. Those are the first two steps before you can really start to do this. There's literally tens of thousands of companies and securities in the world. And so it's really easy to open up a brokerage account, but it's also really overwhelming. And so a lot of people will kind of rely on, word of mouth advice from, people they trust. And I'm not saying that's a bad thing. I have a financial advisor, Dan Batches in Grosse Pointe, Raymond James. Love you, Dan. He's been with me since I was 23. And, I understand exactly how Dan gets paid, and I understand the value he brings to me. Sometimes he encourages me when I need to push, and, sometimes I listen to him and sometimes I don't. He's my professional. He helps me think through these things. So there's nothing wrong with having a professional. Just understand how they're paid. But if you want to DIY, which there's nothing wrong with, if you love the process of researching and learning about the markets and the companies, then you can just roll up your sleeves and there's a million videos on YouTube, besides mine. There's a million books on this topic. And so, I kind of wish you Excelsior and just, go get it. But if you're someone who's maybe not passionate or enthusiastic about the market, but you still want to access it as a way to help you build wealth, there are a lot of really cool index funds. And an index fund is essentially a computer that picks and balances a basket of stocks that tracks a broader, stock market index. And because it's a computer, it's really cheap. It's not a human being. You're not paying a lot in fees. You get instant diversification. Most index funds usually have 40 to 60 securities, at least in the basket they track. And, you can feel confident knowing that you're putting your money in a security that doesn't have any idiosyncratic risk.
These are all really great tips and really practical and step-by-step that you can do if you've got a wealth building mindset. But I'm going to ask this question because I feel like I can already hear my listeners doing this. Well, we're seeing GameStop. We're seeing other stocks move around now. We're seeing this revolution in personal investing. Does that negate some of the things you're talking about? Or what is the real impact of all the noise and things that we're seeing, all the actions that we're seeing right now? So basically, are you saying that these are the tips you need to do regardless of what the situation is?
As boring and as much of a wet blanket as I hate to throw on this fire, I'm going to throw it on there, because think about it this way, Jared. I mean, if I told you that hamburgers cost 50% more today than they did yesterday, would you run out and buy 10 hamburgers? Because when a stock is going up, what that is telling you is that you have to pay more money for your tiny fraction of that company's assets and cash flows. And so for me, I'd rather pay less. And so I'd rather wait until a good company that I believe in, either because of the market or because of something factors unrelated to the underlying performance of the company. I'd rather pay less for those assets and cash flows personally. When a stock is skyrocketing in price and you're on the outside looking in, it means that you missed the boat. And so,
that's a great piece of advice. If it's already on the rocket up, for the most part, you're done.
Right. So tip your cap to the people that happen to buy it, yesterday, and you go find the company that you think is going to be great tomorrow. But these things happen from time to time. In 2008, Volkswagen shares went through a short squeeze because Porsche was gobbling them up, and government, I think, owned like a fifth of Volkswagen. So there weren't as many shares out in the world to purchase to cover as people thought there were. And these things happen. The stock market is, you're watching, fortune won and lost on a daily basis. So you kind of can't help but feel FOMO. And I get that. But all the more reason to just come up with your own strategy, put your head down and ignore the noise. That's how you win this game.
Fight the FOMO, basically.
Fight the FOMO.
Yeah. You know what? I feel like if you've got that kind of thing, I've got an interview coming up with one of the sports betting guys. If you really feel like risking $10 on something, maybe try a line at a sports book as opposed to the stock market.
Yeah, you want to turn $10 into $1,000? You go put together a 7-step parlay, and you can turn $10 into $1,000 with sports betting. You don't need to do that in the stock market.
Well, Matt Rolling, Professor X on YouTube. I'll link to all the things. I appreciate you.
Anytime, Jared. My pleasure.
All right, thanks so much for listening to your Daily Detroit. Tomorrow, we'll have an update on a bunch of things happening, as well as check in with Fletcher Sharp on Matthew Stafford's move to LA and what Detroit City FC is up to. It looks like they're doing some things in the offseason. I'm Jer Stays. Take care of each other, and I'll see you around Detroit.